What if you spent 30 years saving carefully? You retired at 62 with over $600,000 in your traditional IRA. You read every article about doing Roth conversions in your low-income years. You followed the strategy perfectly. You paid the taxes out of your savings so every dollar moved to tax-free Roth status. And then 2 years later, you open a letter from Medicare and discover you are now paying almost $5,000 more per year for the exact same health coverage as your neighbor next door. Not because you went back to work, not because you made a mistake on your taxes, because of income you reported at age 63, income you already paid tax on, income you thought was completely finished. That is not a theory. That is happening right now to retirees all across the country who are doing the smartest tax move at the worst possible age, simply because no one ever sat them down and explained how age 63 is treated completely differently by Medicare than any other year in retirement. This video is for educational purposes only and is not tax or financial advice. The rules change every year and your situation is unique. Please consult with a qualified tax professional or financial planner before making any decisions about Roth conversions, withdrawals, or Medicare planning. Every single week, I break down the tax rules, the financial traps, and the retirement strategies that nobody else is explaining in plain English. If you want to protect your savings from silent penalties like this one, make sure you subscribe right now and turn on notifications so you do not miss the next video. Today, I am going to walk you through exactly why the IRS and Medicare treat age 63 differently from every other age. I will explain the 2-year look-back rule that almost no one understands until the bill arrives. I will show you what this looks like in real dollar amounts using the most recently published numbers for 2026, and I will give you a clear action plan based on exactly how old you are today. Whether you are 59, 61, 62, 63, 64, or already on Medicare. This is not hypothetical. This is the #1 surprise cost I see derailing otherwise perfect retirement plans. Most people know that Medicare Part B has a monthly premium. What most people do not know is that premium is not the same for everyone. The amount you pay is based on your income, and not your income today, but your income from 2 years ago. This is called the income-related monthly adjustment amount, and everyone calls it IRMAA. In 2026, the standard Part B premium is projected to be around $206.50 per month for most retirees. That is the base rate you pay if your modified adjusted gross income from 2024 was at or below $109,000 for single filers, or at or below $218,000 for married couples filing jointly. But if your income from 2 years ago was even $1 over those thresholds, Medicare adds a surcharge on top of your premium. And this is not a gradual increase, it is a cliff. Cross that first threshold by a single dollar and your entire premium jumps to the next tier for the whole year. For a married couple where both spouses are on Medicare, just crossing that first cliff means paying roughly an additional $1,800 per year combined for the exact same Part B coverage. Not because of what you earned this year, but because of a tax return you filed 2 years ago. Let me give you the 2026 brackets so you can actually see the cliffs. These numbers are published annually by the Centers for Medicare and Medicaid Services, and they adjust slightly for inflation, so always verify the current year at medicare.gov. For 2026, based on your 2024 tax return, the tiers look like this. Below $109,000 single or $218,000 joint, you pay the standard amount, about $206.50 per person per month. From $109,000 to $136,000 single, or $218,000 to $272,000 joint, your premium jumps to about $280.50 per person per month. From $136,000 to $163,000 single, or $272,000 to $326,000 joint, it jumps to about $371.60 per person. From $163,000 to $195,000 single, or $326,000 to $390,000 joint, it is about $462.70 per person. from $195,000 to $500,000 single, or $390,000 to $750,000 joint, it is about $553.80 per person. And above $500,000 single or $750,000 joint, it is about $617.30 per person per month. Think about that for a married couple. At the standard rate, both spouses together pay just under $5,000 per year for Part B. At the top tier, that same couple pays nearly $14,800 per year for the exact same coverage. That is almost a $10,000 difference every single year based entirely on income from 2 years prior. Now here is the rule that makes age 63 so dangerous. Most people enroll in Medicare at 65. When you enroll, Medicare does not look at what you earned at 64 or 65. It looks back 2 full years. Your premium for your entire first year of Medicare at age 65 is based on your modified adjusted gross income at age 63. Your premium for your second year at 66 is based on your income at 64. Your premium at 67 is based on your income at 65. The look back never stops as long as you are on Medicare. That means if you are 63 right now, every single financial decision you make between now and December 31st is directly setting your Medicare bill at 65. That Roth conversion you are considering, that large withdrawal from your traditional IRA to pay for a new roof, that decision to sell a highly appreciated stock you have held for 20 years, that rental property income, all of it flows onto your 2024 or 2025 tax return, and Medicare will use that exact number to calculate your surcharge 2 years from now. If you are 62 right now, your income this year will set your premium for age 66, your second year on Medicare. That still matters enormously. If you are 61, you have one more full year outside the initial look-back window. Your income at 61 will be too old to affect your first 2 years of Medicare premiums. That gives you a precious planning window. But once you hit 63, the clock starts, and you cannot unwind it. Let me be very direct about the mistake I see most often, because almost every retirement article gets this half right. They tell you to do Roth conversions while your income is low in your early 60s. That advice is correct for income taxes. What they completely forget to tell you is that income taxes and Medicare IRMAA are calculated separately. You can do a Roth conversion that results in 0 federal income tax because you stayed inside the standard deduction and low brackets, and still trigger a $3,000 annual Medicare surcharge 2 years later because that same conversion pushed your modified adjusted gross income over an IRMAA cliff. The IRS looks at your taxable income. Medicare looks at your MAGI, which includes tax-free interest and other items, before most deductions. They are 2 different formulas pulling from the same tax return. Let me walk you through 3 real-life scenarios so you can see yourself in one of them. First is David. David is 63, single, retired at 61 from a manufacturing job in Michigan. He has a $420,000 traditional IRA and a small pension that covers his bills. His income is low this year, so he decides to convert $120,000 to Roth. With his pension and the conversion, his MAGI for the year lands at about $139,000. That puts him just over the $136,000 mark, which is the second IRMAA tier for single filers. 2 years later, when David enrolls in Medicare at 65, instead of paying the standard $206.50 per month, he pays about $371.60 per month. That is an extra $165 per month, or nearly $1,980 for that first year. Because the look back lasts, he pays that same surcharge again at age 66 based on his age 64 income. In total, that one conversion decision at 63 cost him almost $4,000 in extra Medicare premiums. If David had done that same $120,000 conversion split over age 61 and 62 instead, or even split $60,000 at 62 and $60,000 at 63 to stay under the first tier, he would have avoided the surcharge entirely. Same smart strategy, different timing, $4,000 saved. Second is Sandra and Thomas. They are both 63 and file jointly. Sandra still does part-time consulting and makes about $48,000. Thomas has started Social Security at $24,000 per year. They also sold some stock this year that Sandra inherited from her father decades ago. The long-term capital gain was $85,000. Then Thomas took a $30,000 IRA distribution for a home renovation. Their total MAGI for the year ends up around $245,000. They were not trying to be aggressive, they were just living life. But $245,000 is above the first joint threshold of $218,000. 2 years later, when they both start Medicare, instead of paying about $206.50 each, they each pay about $280.50 per month. That is about $74 extra per person per month, or about $1,176 extra per year for the household, and they will likely pay it for 2 years until the lookback moves past that high-income year. That is over $3,500 for what felt like normal financial decisions. If they had known about age 63, they could have sold that stock over 2 tax years, or used cash savings instead of the IRA withdrawal, or delayed Thomas's Social Security for a few months to manage their MAGI. None of that requires a complex trust or advanced planning. It just requires knowing the rule before December 31st. Third is Margaret. Margaret is 63, a retired nurse from Georgia. She has a pension and Social Security totaling about $64,000 per year. She has no IRA, no brokerage account, no large assets to sell. She has never heard of IRMAA. When Margaret enrolls at 65, she will pay the standard premium because her income at 63 was well below the thresholds. For Margaret, age 63 is not a critical year. And honestly, Margaret represents the majority of retirees. If you live primarily on Social Security and a modest pension, and you do not have large pre-tax accounts you control, you will likely never hit IRMAA. But if you have a traditional IRA, a 401k, a 403b, a taxable brokerage account with gains, rental income, or any source of income you can turn on or off, you are not Margaret. You are David or Sandra. And the decisions you make at 63 can cost you thousands per year for multiple years. If this is starting to make sense, hit the like button right now. It helps this video reach more people in their early 60s who are about to make this exact mistake. And if you have not subscribed, do that now. Here is what makes age 63 uniquely complicated. It is not just IRMAA, it is that 3 completely different financial systems all want something different from your income at the exact same age, and you have to choose which one to prioritize. System 1 is the IRS income tax system. At 63, many of you are in the lowest tax bracket you will ever be in again. You are retired, you have not started Social Security yet, and you have not started required minimum distributions at age 73. Planners call these the gap years. The tax code says this is the perfect time to fill up low brackets with Roth conversions. System 2 is the Affordable Care Act subsidy system. If you retired before 65 and are buying health insurance on the marketplace, your premium tax credit is based on your MAGI. The lower you keep your income, the bigger your subsidy. A couple at 63 can easily save $12,000 to $20,000 per year in health insurance premiums by keeping their MAGI under the subsidy cliff. The ACA system says keep your income low. System 3 is Medicare IRMAA. IRMAA also says keep your income at 63 below $109,000 single or $218,000 joint if you want to avoid a surcharge at 65. Do you see the conflict? The tax system is pulling you to create more income at 63. The ACA and IRMAA systems are pulling you to create less income at 63. You cannot satisfy all 3 perfectly. You have to make an intentional choice based on your numbers. Take a hypothetical couple, both 63, with $500,000 in a traditional IRA and buying ACA insurance. If they keep their MAGI at $70,000, they might get a $15,000 annual subsidy for health insurance. They can only convert maybe $10,000 to Roth that year. If they instead convert $100,000 to Roth, their MAGI jumps to $160,000. They lose the entire ACA subsidy, and they also cross the first IRMAA tier, meaning they will pay higher Medicare premiums at 65. That conversion might cost them $15,000 this year plus $1,800 in 2 years. Is it still worth it? Maybe if that $100,000 growing tax-free for 20 years saves them far more in future RMD taxes. Maybe not, if they only live another 10 years and would have stayed in a low bracket anyway. There is no universal right answer. The only wrong answer is not knowing all 3 systems are in play before you decide. Now let me give you the full timeline so you understand this is not just a one-time event at 63. The look back is forever. Your 2026 Medicare premium is based on your 2024 income. Your 2027 premium is based on 2025. Your 2028 premium is based on 2026. Every year you are on Medicare, Social Security pulls your tax return from 2 years prior. That is why a 75-year-old retiree who takes a large RMD at 73 to buy a vacation home will see an IRMAA surcharge at 75. The difference is that at 73, RMDs are forced. At 63, the income is almost always voluntary. You have control now that you will not have later. That is why planners say do your heaviest Roth conversions at 60, 61, and 62 if possible. By the time you are 65, that income is already 3 years old and Medicare will never see it. What if you already got hit with IRMAA and your income has since dropped? There is a process for that. It is called a life-changing event appeal, and you file Form SSA 44 with Social Security. Qualifying events include that you retired, you reduced your work hours, your spouse died, you got divorced, you lost pension income, or you lost income from income-producing property due to a disaster. What does not qualify is simply saying you chose to do a one-time Roth conversion and now your income is back to normal. In that case, you do not need an appeal, you just wait for the look back to roll forward and your premium will automatically drop. But if you had a real life change, the SSA 44 is powerful, and you can now file it online at ssa.gov. Most retirees who qualify have never heard of it. There is one more brutal version of this trap that almost no one talks about, and it is called the widow's penalty. While you are married filing jointly, you get the higher $218,000 IRMAA threshold. When one spouse passes away, the surviving spouse must file as single the next year, and the threshold drops to $109,000. The same income that caused zero surcharge as a couple can suddenly trigger a massive surcharge as a single filer. Imagine a couple with $200,000 in combined income from pensions, Social Security, and RMDs. As a joint filer, they are under $218,000, so they pay the standard Medicare premium. Then the husband passes away. The widow still has essentially the same $190,000 in income from the pensions and her survivor benefits, but now she files single. That $190,000 is now well above the $163,000 third tier for singles. Her Part B premium jumps from about $206 to about $463 per month overnight. That is over $3,000 more per year for the same coverage, not because her income went up, but because her filing status changed. This is why doing Roth conversions while you are both alive and can use the higher joint thresholds at ages 61, 62, and 63 is one of the greatest gifts you can give the surviving spouse. You are prepaying the tax now and giving them tax-free Roth money to live on later, which keeps their future MAGI low enough to stay under the single IRMAA cliffs. So here is your action checklist based on your exact age today. If you are 60 or 61, you are in the golden window. Your income now will not hit your initial Medicare premiums. Model your tax brackets and convert aggressively but deliberately over the next 2 years. Get as much money out of your traditional IRA at today's low rates as you can stomach, because you will never have this much control again. If you are 62, you are standing at the edge. Your income this year affects your second year of Medicare. You still have time, but you need a 2-year plan for age 62 and 63 together, not 2 separate yearly decisions. If you are 63 right now, stop everything and pull your last tax return before you do any more Roth conversions, stock sales, or IRA withdrawals this year. Look at line 11 of your Form 1040 for your adjusted gross income. Add back any tax-exempt interest to estimate your MAGI and see where you are relative to $109,000 if single or $218,000 if married. Every dollar you realize above that line between now and December 31st is potentially buying you a 2-year Medicare surcharge. Only cross it on purpose after you have run the long-term math. If you are 64, your income this year sets your premium at 66. This is often the year people start Social Security, which makes managing MAGI harder. Run the projections now. If you are already on Medicare and you are consistently over the thresholds because of RMDs, look into qualified charitable distributions. In 2026, you can give up to about $110,000 directly from your IRA to charity, and that amount never shows up in your MAGI at all. It satisfies your RMD and keeps you below IRMAA. It is the single most powerful tool for retirees over 70 and a half. The reason so many people get caught is not because the law is secret. The information is on ssa.gov. The problem is that most advisors talk about taxes in a vacuum. They say convert while your income is low, and they are not wrong. But they fail to add the critical sentence, and be careful at age 63 because Medicare is watching. That missing sentence is costing retirees thousands. The retirees who win this game are not the ones with the most money. They are the ones who understand that age 60, 61, 62, 63, 64, and 65 are 6 completely different tax environments. Age 61 and 62 are your last free shots. Age 63 is when Medicare starts its 2-year timer. Age 64 and 65 lock in your first 2 years of premiums. Treat each birthday like a deadline, not just a celebration. Remember the story from the beginning. That retiree did the Roth conversion at 63, paid the tax correctly, and then paid almost $5,000 extra in Medicare premiums over the next 2 years because of it. 2 years later, his premium dropped back to normal automatically. The surcharge was not permanent, but it was completely avoidable with better timing. He did the right thing at the wrong age. Do not let that be you. Pull your numbers, know your thresholds, and make your income decisions with all 3 systems in mind. If you found this helpful, share it with someone you love who is 62 or 63 and has a retirement account. You might just save them thousands. Tell me in the comments below, did you know about the 2-year IRMAA look back before this video? And what age are you right now as you are planning this? Retirement Wealth Watch.